1 naira today is more than 1 naira you have tomorrow. The one you have now, if you invest it, it's going to give you more.
Working smart has actually, been the forefront of it as against working hard. So you probably need to work smart first, then make it up with hard work.
Don't put all your eggs in one basket.
Good morning.
Good
Anyway, in light of what you said, right? Definitely it is in recent times. It's working smart has actually, been the forefront of it as against working hard. So you probably need to work smart first, then make it up with hard work. And today we're looking to shed more light on how to build a resilient portfolio in Nigeria today. And we have with us Mr. Idika Aja. Sorry.
Yeah. Good morning, Ogiva and Kayode.
Welcome back.
Thank you.
Welcome back.
Quite some time.
Yeah, it's just been difficult, really, and it's getting harder these days. Definitely, investing right, is literally the way forward. So we're looking to have you shared some, knowledge with our audience today. Thank you again for coming.
Okay.
Before we even go into anything, right, really, what is a portfolio? Let the audience know for those.
Okay. Yes, I know we know. Even the audience, those who are listening, everybody will know the word portfolio. At least we hear portfolio. But before we do that, we're talking of investment portfolio, not normal
portfolio. Exactly.
So we have to clarify that.
Yeah.
But before we go into that, let's first of all recap our normal investment strategy. We should always realize that 1 naira today is more than 1 naira you have tomorrow.
Yes.
You understand?
Yes.
Because if you keep it, definitely the one you have now, if you invest it, it's going to give you more. Now, and it must do 3 things for you. It must compensate you for at least for putting it somewhere. That is one. That is the interest rate it's giving you. 2, you must ensure that it compensates for the inflation risk. And 3, you must compensate you for the premium risk. We said this several times here.
Yes.
That is the ideology. That is the game for investment. Anytime you are trying to invest, you must consider these 3 things: the interest rate, the inflation premium, and the risk premium. You must consider them. Now, what is a portfolio? Let me just describe it so that we don't speak too much grammar. A portfolio is just like a basket.
Okay.
Having different types of fruits. Orange, mango, so on. So it's like that. When you talk of an investment portfolio, it's a sort of a basket having different types of asset classes.
So the fruits in which your example are your different investments.
Yes, there are different investments. You have a bond, you have stock, you have mutual fund, you have commodity like gold, and so on. So when you put all of them, that is what we call investment portfolio. Yes. So, in a very simple, easy way for people to understand.
Okay, so why is it? Excuse me. So why is it important that everyone has a portfolio? Is it really just about making money, or there's a bigger picture to it?
Yes, there is. It's not just about making money. When you look at investments, the key thing is just it's not just about your return. It's about keeping your money safe. That's the key thing. Okay. Not just the return, but to make sure that you have your money back, the money is safe. Now, when you talk of building a portfolio, the idea is to diversify your investments. You understand? You diversify them so that you reduce the risk of losing
from one particular fruit, right?
So it's just say don't put all your eggs in one basket. So that is the essence of building a portfolio. You are trying to diversify, put this one into bond, put this one into stock, put this one into mutual fund, put this one into commodity, put this one into real estate. So that is the key. That is the essence of investment portfolio.
Okay, so we're not just even talking about investment portfolios right now. We're talking about building a resilient portfolio in Nigeria today because of, with the way things are today. So how does resilience come into
when you talk of resilient portfolio, it means you have different situations. You have different periods, and you have challenges in an economy. Things change, and you have to adapt to those changes in order to survive. So that is meant by resilience. So when you talk of building a resilient portfolio, that means you have to work in line with the trends, trying to overcome the trend, trying even to beat the market. So in trying to do that, you have to build a resilient portfolio. And how do you do that? You do that by looking at the environment. Things continue to change. You continue to change. You continue to adopt. Continue to rebalance your portfolio. For instance, now few years ago, treasury bills, federal government bonds, they offered a yield as low as 5%. Then, now because of the prevalent situation, the issue of inflation, then federal government has the need to increase interest rates. Now those bonds, treasury bills that offer the yield of 5% are now giving yield between 15 to 20%. Now, if you have a portfolio, that means you have to go back to your portfolio. As means you have maybe about 10% invested in treasury bill, because it's not giving more yield. You have to now increase it or rebalance it. Those ones that were not giving enough yield, you bring it down. Like now you put more in bonds, in treasury bills. So that's the essence of portfolio. You can now see, because of the environment, because of the microeconomic factor, that's like inflation and interest, like especially inflation that has influenced the interest rate. You can now see that some asset classes are now offering more yield than before, than the trend. So you come back to your portfolio and rebalance. That is the essence.
I see.
See how to build that resilience. So you have to look at the prevalent situation and see how you can navigate it and see what you have to add. The one, add this one, change this one, add this one. So that is the essence. That is how to build, so that you'll be able to overcome these challenges. You'll be able to overcome the prevalent situation.
Okay, which you are experiencing.
Yes,
anyway.
which are because now, if you let me give an example. Now, if you look at the bank's financial reports of recent now, you see that most of the banks have migrated to, they are putting more money in investment in securities, like federal government bonds, treasury bills, because of the high interest environment. Almost matching the traditional income, which is the interest income from loan and advances. Because of the high interest environment, which is equally boosting their interest income too, from loan and advances. So you see how how a microeconomic factor is reshaping the banking investment. So that's equally go a long way to affect your portfolio too. As mean, like you have a banking stock, or you are into shares. You can now say, okay, because banks, you are sure the banks are likely to make more money because of the interest rates. And you can now pick bank stocks, and one, definitely, even if the share capital is not moving fast, at least you are sure of dividends. You are sure of dividend, because the higher their income they make, that is their profit after tax, they are likely to declare dividend, which is what we are seeing. So most of them increase their dividend. You can see, I think during their AGM, Central Bank, they are sure that yes, we are going to increase our dividends this year.
I remember that. And with what you've said, like, because myself and Kayode are actually, asking each other, how do you actually mix it up, as a Nigerian today now, right, with all what we've said? How do you actually know what to mix up with which makes your basket, your portfolio, right?
Yeah, let's use that basket.
Yeah, let's still work with the basket. So so the layman can still, follow us. So that basket of fruits, which are your investment, how do you know what to mix up in there right now as a Nigerian?
Okay. That's a very good question. That's a very good question. A good one. Now, like I said, when you are balancing your portfolio, the key thing is not just only the return. It's equally not to lose your money.
Yes.
Now, there's what we call return and risk. And there are metrics that you use to measure it. So we'll go into that, even though it's going to be a little bit technical, but I will try as much as possible to explain it. Now, you have return on one side. You have risk measured by what we call the standard deviation. Now, let me use one example. Commercial paper. You know commercial paper. We've talked about it. Then you know gold. Which is a commodity.
Yes.
Now you have CP. Let's assume that you have commercial paper in your basket.
Yes.
You have gold in your basket, or you want to add them, and you are looking at, you want a return of that your portfolio. You are looking at 30% return. Remember what I said? That 30%, at least he has certified the first rule that you must give you return. He has certified the second rule because it is more than the inflation rate. And the third one, at least it gives more than federal government instruments. It's offering high instrument, 30%.
Okay.
Now, what you do is this. Normally, if you go to the apps, investment apps, normally they have trailing returns. That's past returns. Let's assume that we are looking at 6 months period. Now, Treasury bill is giving you, commercial paper is giving you 25%. We know it is stable. It is 25%. Now, gold, let's look at the prices, monthly prices. Now, gold, maybe for instance, in January, traded at maybe 25,000 naira. In February, came down to 12,000. March went up to 70,000. That is a red flag for you.
Okay.
Do you get the point? Because the prices fluctuate.
Yes.
Unlike commercial paper that is stable. Now that means, what is it telling you? It has a higher standard deviation, which is a higher risk. Now, by the time you finish working it, if I finish calculating, gold might give you a higher return, let's say 48% annual. Then 6 months, that will give about 24%. Now, commercial paper is giving you annual 25%. 6 months, that's about approximately 13%. This one gives you lower return of 12%. This one gives you higher return of 24%. But this one has a higher standard deviation, let's say of 15%. This one has, because it's stable, 2%. I'm just trying to explain how you can now know which one to pick. Now, because this one has 24%, this one has 24% return, this one has 15%, that is risk. That means it's telling you that, yes, even though this one offers a higher return, it has what? A higher risk. Standard deviation means the tendency of an asset return deviating from the mean return. That is the meaning of standard deviation. And we can now see that, yes, because of the fluctuation in gold prices, the standard deviation is high.
It's high, yeah, for sure.
Now, not to waste much time, but by the time you calculate it, maybe you can easily do this thing, use your Excel, work it out. You don't even need anybody to assist you. You know, at times the internet, you can
Google you can get tutorials online.
You can go tutorial online. But the most important thing, I'm just giving you the basis.
Yeah.
Get your return, which you can, even the apps, investment apps you use, you can easily get it, get the historical returns, then look at the standard deviation. The higher the standard deviation, the higher the risk. The lower the standard deviation, the lower the risk. Divide this one by the return by the standard deviation, you get what we call the Sharpe ratio. That Sharpe ratio tells you, okay, how much you are paying per each unit of risk. So if the Sharpe ratio is high, it is okay. That means you should increase your investment in that particular asset in your portfolio. Now, assuming if you want to achieve 30% return on our portfolio, you can see that by the time you finish working it out, by the time you finish working the whole thing out, you can see that assuming you have 10 million naira to invest,
Okay.
then your calculation will equally show you that, okay, invest up to 75% of that 10 million in commercial paper, and the other 22% in gold. That will not give you 30% return you are looking at. So the essence of the portfolio balancing is to know which asset class to increase, based not only on the return, but equally what? On the risk level.
On the risk level.
So there are two things there, the risk and the return. So you don't only consider the return, which is what most of us will do. So somebody will just tell you, this asset is giving me 30% return. You carry all your money and go and put there without considering the risk. Then the possibility of you losing the whole money, maybe 10 million naira is there, you can lose it. So that is the essence of portfolio balancing.
Okay, so we've spoken about this before, really, and it's actually trended. The CBEX.
Yes.
Is kind of the right word. But for that in that scenario now, right? Anyone fixing his or her money is looking to invest, right, and get returns. So for somebody like Kayode now that lost $50,000
in
CBEX, what lessons can you please give to someone like Kayode?
The key thing, the takeaways are: one, invest in legitimate businesses. Those ones that are licensed, managed by licensed professionals, that you know that they are registered. That is one. But on CBEX, though I interviewed some of the, I call it the victims, because some of them knew that it is a Ponzi scheme. They just wanted to just throw in money,
quick cash,
and cash out. So I don't really want to use that because some of them knew. But even at that, my advice but there are some who didn't know. So my advice is this: it's very simple. Anytime you want to invest or you want to put money somewhere, you go to Security and Exchange Commission, SEC, their website. You have the NGX group. The website is there. If you just go to the website, search, you'll see registered capital market operators. If the name is not there, don't invest. Period.
Okay.
Even if you want to invest in stock, go to NGX, their website. You see registered and active stockbrokers. Look for the one that they have given you, or somebody has approached you of market. Say, okay, invest in this company. If the name is not there, you said the name is not there, it is not registered. That means it's not licensed. They are not authorized to operate, and anything can happen to you.
Yeah, and you will lose your money.
You lose your money. If you lose your money, because you see, before you are recognized as a capital market operator, even to collect money from people or even to collect and invest for them, it's a rigorous process. Normally, SEC will require what we call trade-sponsored individuals, and those are licensed professionals. You go through the process, you go through their training, and those three people are recognized by SEC. So even if anything happens to the company, SEC will first of all hold them. Either they may be their professional, either chartered stockbrokers or chartered financial analysts or chartered accountants. So it's a long process. So anytime you want to invest, do your due diligence. The net is there. The net is there. So you don't even need anybody to come and tell you. But like I said, most of them already knew that it's a Ponzi scheme.
The temptation.
Yeah. That is the same thing we are saying now. If somebody offers you a return of, say, I'll give you 100% return on investment, the first thing you should ask is, where are you investing that money that will give you that 100% return?
What are they doing? Where's the money? How's the money being
that should be the first question you should ask yourself. Okay, if I come to you and say, okay, I have an investment outlet, bring 5 million naira, I will double it. The first thing that should occur to you, where am I going to put that money? Is it in heaven?
Exactly.
Or on this
double 100%.
To give you 100%. That is the first question. That's a red flag. That is the first question you should ask yourself. Where is the person going to invest? Traditional assets are giving you 25, like CP bonds, between 20 to 27%. Even if you are investing in stock, you have to wait for a longer period for you to even get it. Even in crypto.
Yeah.
Even in gold.
In gold as well.
So it fluctuates. So if somebody come and tell you, okay, I will give you so return, the first is a red flag for you. Ask, where are you putting this money?
Okay. So I think that's pretty much cleared it all. Yeah. So for someone that has lost, let's still work with that example, like Coyote that has lost $50,000. How do you advise that kind of person to, bounce back? I mean, getting $50,000 back is a stretch, but what advice would you give someone like that? How would you advise a person applies him or herself?
Okay. One, if you have lost your investments,
Coyote,
if you have lost your investments, one, if we are specifically on CBEX, I think I don't have much because I know the regulatory authorities said they are working on it, but I'm not too sure what they are going to do, how they intend to do that. But I think that one has passed. You have lost the investment, so the only thing is just to learn from the past, from your mistake, and going forward, you should understand that making money is not an overnight thing. It's not something you just put and collect back. No, you have to start gradually, and you build it. And Coyote is still a young man, so
Coyote is almost Gen Z.
So he has to come back, at least come back and start building, like what I've just explained. No, it is something that you start gradually, slowly, and you start building and come up again. But for the one he has lost, let's wait and see what the regulatory authorities are going to do.
He has money, Sha. For him to remove 50,000, you still get money with that.
Yes,
he will be fine.
And that is why it's always good to invest in a legitimate and licensed business, because even in according to Investment and Security Act, the regulatory authorities like NGS and SEC, they have what we call the investment trust funds.
Okay.
So all those marketed operators, they're expected to keep certain fund in case if anything happens, then the regulatory authorities will equally look at the investment fund and see how they can recover and pay the investors. So that is why it's very, very important that whenever you want to invest, make sure that the company, the outlet is legitimate and is registered with the regulatory authorities. So whether it is a commodity you are investing in, or financial asset like stocks, bond, and so on. So make sure that the outlets, the operators are licensed and properly registered.
So at least whatever the case is, there will be some way of getting your money back.
Definitely. At least even the promoters, even the management of the company will know, okay, the searchlight is on us. We can't just disappoint or misbehave.
Okay. Thank you very much, Idika. I think we pretty much covered most of the angles to it, and I hope at least the listeners out there looking to build resilient portfolios, or people that actually need to understand the value of having a resilient portfolio in Nigeria today. I hope we have actually been of service to you, and we'll call it a day right now. We'll look forward to seeing you next week. Don't forget to subscribe to our YouTube channel, and also catch up with us on Spotify as well. If you can't be watching videos, but I'll still advise you you can catch up with this on our YouTube channel, so you can get to see us and feel the energy in the room. Without further ado, I look forward to seeing you all next week. Have fun. Bye.